Stock Play of the Day Overtime is an educational program. Any statements made by Ally Invest employees are not intended to be or should be considered investment advice, a recommendation to buy, sell, or hold a security, or a recommendation to adopt an investment strategy.
Hello and welcome to the Stock Play of the Day Overtime Edition. On Tuesday's Stock Play of the Day, we talked about Disney. Today we'll discuss, did we score or did we fumble? Hello, my name is Brian Overby. I am the Senior Options Analyst with Ally Invest. On Tuesday's Stock Play of the Day, we discussed a long calendar spread with calls on Disney. Now, I'm showing the long calendar spread here inside the Options Playbook website. And whenever we are talking about long calendars around earnings, we're usually doing them directionally. So we're going a little bit out of the money on our strike price relative to where the underlying stock was at. That strike price inside the options playbook would be represented by strike A. The underlying stock was at 183.66, and the calls that we used, the strike price was the 187.50 call. So leaning a little bit to the bull side when we do the trade, but it is a neutral to bullish type strategy. Now, if you wanted to use puts, we discussed this on the show, you could go the opposite direction and you would just pick a strike that was a little bit out of the money relative to the put sides and be a little bearish going into Disney on earnings. So let's talk about what happened with the stock. As far as Disney was concerned, we have a chart here since Tuesday, which was the 4th of May. We always tape the stock play of the day at noon Eastern time. This is a 15-minute chart. So from noon Eastern time, we see the underlying stock was right around 183.66, but it actually, we kind of were hitting the high of the market when we were talking about the trade for that day. Market did go down, stayed a little bit flat at the end of the day. It was up just a little bit into the close, a little bit on Wednesday, started up, then it went down precipitously. Well, not a huge move. Basically, it went down around 3 points or so. Traded right around the 181 area was basically where the bulk of the volume was at. And now on Friday, we've had a fairly strong day. And here we are at 184, 184.46. That's where the underlying stock is at. This is a live market. As always, when we take stock play of the day overtime, we're doing it live. So, what happened with our trade? So, overall, this was a good thing for our trade. We're up a little bit on the trade. And if we go back and look at the actual chains here, let's see where Disney's at exactly right now. It's 184.59, up $2.80. We're highlighting in the Ally Invest option chains that the earnings date is on the 13th. It's after the close. We talked about the May 7th expiration, a very short term long calendar trade. And we did the 187.50 strike. That was the strike that we chose. So we sold the short term option contract, hoping that that would expire worthless. And so far, that looks like that's going to happen. We sold that for right around 70 cents. Right now, it's trading at 8 cents, 7 cents by 8 cents. Very good, tight market on it. And that was the contract that we sold. If I scroll down to the May 14th, they are announcing earnings. That is a Thursday, the 13th is. So these options have 1 day to live after that expiration, after that earnings announcement, I should say. And we see that that is trading for 260 by 266. So overall, we paid a lot for this 187.50 call. As a matter of fact, oddly enough, the volatility hasn't really gone up at all in the back month. Now, the front month, we were depending on time decay to get rid of our value, and that has definitely happened. But vols haven't changed much on the back month, which would have helped us out a little bit. Part of the reason why we do long calendars is that ultimately, if your forecast is correct and this underlying stock comes up towards that strike, but doesn't quite get there, doesn't quite go beyond, well, in that instance, then you're hoping that implied volatilities go up because this option contract and this expiration you want to expire worthless, which leaves you long a call option. And if implied volatilities go up because of that anticipated earnings report, then you would see a spike in premium just based off of implied volatility move. It has nothing to do with the underlying stock. but balls didn't move much. So overall, we are up on the trade, but we're not up a ton. I would expect to be up a little bit more considering that stock was at 183.66 and we see it right now at 184. It's up about 90 cents since we talked about the trade on Tuesday. So I'm going to put this in the right rail. And right now I'm going to highlight the fact that we paid around the midpoint was $2.43. You can never guarantee a midpoint fill when you're doing a spread, but that's where our reference point was. And we now see it at 255. So if we were to close this trade and try to capture that dime, all of a sudden you've changed your mind about the trade. But ideally, this is working out just fine from the way that we've done it. And I'm also going to give you an alternative to just closing out the trade. But you would go in and on the option contract that we sold, we would change this to a buy to close, that May 7th expiration, that's the nearest term expiration, 187.50. And then this contract that we bought to open, we would change that to a sell to close. And now we'd be looking to do this at a net credit of $2, and now it's $2.55. So I guess it's came off a little bit since we started talking here, but a net credit of $2.55. Sell that, close out that trade. Our risk is off the table, have a small gain, and we would move on. That wasn't the plan when we talked about it on Tuesday. So what's an alternative trade that we could do here? Well, in this instance, we're going to capture most of that 70 cents on the 187.50 strike. Now, you could just let this ride, let that expire, go into next week. Hopefully, we get a little bit of a spike up in implied volatility and a little bit of a move up. So you have until Thursday for this option contract to live. And if it did make you a decent profit, let's call 50 cents, 75 cents or so on your long option contract, well, I would think about just getting out of that trade. It's all about what your forecast is for the earnings, but I would rather take risk off the table, a decent amount of risk, as opposed and not have to go through the earnings report, as opposed to all the risk of what happens at the earnings announcement overall. But our goal was to ride this into earnings. And if you planned on doing that, then here would be my adjustment to this trade. So far, that front month has expired just like we wanted it to. There's only 8 cents left in it right now on the ask price. But this is the long option contract. Now, keep that in mind. I'm going to highlight that you're long the May 14th, 187.50 strike call. What I would look to do is buy to close the 187.50 today. It's only got 1 day to live. At the end of the day, it's completely done. I should say it's only got about 4 hours to live. And then we're going to take that and sell to open. We can still get a lot of juice, 5 points higher than the strike that we own, the 182.50 or even the 190 if you wanted to take more risk off the table. I would prefer to give myself a little bit more upside. So I'm going to actually propose selling the 192.50. Now, I'm keeping this buy here because ultimately, if we execute this trade, then we are going to be long a bull call spread going into earnings on Disney. And I don't mind this because Disney's announcing on Thursday. By Friday, all this time premium has to come out of the trade. Now, I don't have unlimited upside by doing this, but I can take some more risk off the table by doing this roll. So I'm going to get rid of the position that would already be in your account. That would be the 187.50 strike. And our official adjustment trade for the stock play of the day overtime, I'm going to have to change it up just a little bit here. So we are buying to close, as I mentioned just in the last right rail session. We are buying to close the 187.50 for next to nothing, about 8 cents, and then selling to open the 192.50. Now we're going to try to bring in a net credit of $1.24. Okay, so let's go through the math. We paid about $2.43 for this underlying for this trade on Tuesday, $2.43. If we adjusted the trade, we would be rolling into that long call spread, which is $1.24 doing this live. That means now our total risk that we would have on this trade would be $1.19. We would have a potential of a maximum potential upside of 5 points, and looking at which is the width of the spread, 5 points. So 5 minus $1.19 means that we have $3.81 of upside. And the expected move is more than 8 points in this instance, which implies that the underlying stock could get to that 192.50. That's where the over under is set based off of what the long straddle is trading at in that May 14th expiration. So, not a bad adjustment to the trade if you would like to. You could just stay the course, or you could just sell it and get out of the trade. On paper, we're up about a dime or so. When we started the call, we were up about 20 cents, which was a little bit more feasible overall. But right now, we would be up about a dime. So, not a bad adjustment on this trade. And we'll see what happens next week with Disney earnings. And that's going to be it for this edition of the Stock Play of the Day Overtime. My name is Brian Overby, Senior Options Analyst here at Ally Invest. Myself and Callie Cox will be back this Tuesday at noon Eastern Time for another edition of the Stock Play of the Day. You might want to click subscribe and ring the bell, and you will get all the alerts for all the stock plays of the day. Thanks for coming.